What if I told you the single best piece of investment advice ever written came from a book that costs less than your morning coffee, and 99% of people who read it still fail to use it? Because that book, according to Warren Buffett, is the best book on investing ever written. And the lessons inside will save you from making the mistakes that wipe out most people's wealth. This isn't some secret formula for getting rich overnight. This is about how to think, how to act, and how to control the only thing that actually matters in the market: you. My goal today is to break down the 5 most crucial rules taught by Benjamin Graham, the man who shaped Buffett's entire life. These are the principles that protect your capital, save you from panic, and actually help you build wealth long term. I'm talking about how to buy when everyone else is selling, how to avoid the ultimate emotional trap, and the single math problem that determines if a stock is a steal or a trap. If you master just these 5 things, you are already way ahead of most of the experts out there. Let's dive into takeaway number 1. Meet your crazy neighbor. Rule 1. Mr. Market. Graham called the stock market by a name, Mr. Market, and he is the reason most people fail. Imagine you own a thriving coffee shop, steady profits, regular customers. Every day, this dramatic, emotional neighbor, Mr. Market, rushes in with a completely different offer to buy your business. Day 1, he storms in. "I'll give you $1 million. Coffee is hot right now." Day 2, he drags himself in, miserable. "Coffee is dead, man. I'll give you 50 grand tops. Sell now before it's too late." Day 3, he's back, all excited. $700,000. "I changed my mind again." Would you take Mr. Market seriously? Of course not. You'd laugh, you'd roll your eyes. But when the stock market, which is essentially thousands of Mr. Markets, does this, everyone listens like it's gospel. Graham's crucial insight: Mr. Market is obsessed with fear and greed, and he is usually wrong. You don't have to sell your business just because he's moody. The smart move: use his mood swings. When the Microsofts, Apples, and Amazons of the world got way cheaper during the 2020 crash, it wasn't because they became bad businesses. It was because Mr. Market was having a meltdown. That panic created opportunity. Your job isn't to predict where prices go next week. Your job is to understand the value of what you own and act only when it makes sense. That's how you win long term. By the way, if you are finding this perspective helpful and you want more ways to grow your wealth steadily, do me a quick favor, hit that like button and subscribe. Rule 2. Investing versus speculating. Takeaway number 2. Stop gambling, start owning. There is a massive difference between investing and speculating, and Graham warns that most people think they are doing the first when they are absolutely doing the second. Investing is calm, thoughtful, and long-term. It's like buying a house. You check the plumbing, the schools, the neighborhood, because you plan to live there for a decade. Speculating: that's buying a house just because your barber said prices are going to the moon. You have no clue what it's worth. You're just hoping someone else will pay more. You're chasing hot stocks, meme stocks, and short-term headlines. Let me ask you this. If I offered you a tiny piece of a pizza shop, you don't know the owner, the revenue, or if they even sell pizza, would you buy it just because I said it's going to blow up? No way, right? Yet people do that with stocks every single day. Look at the dot-com bubble. People threw money at anything with .com attached, regardless of whether the company had zero revenue or sold nothing but dreams. It crashed because people were speculating, hoping for hype, not value. Graham's golden rule: treat a stock like a part ownership in a real business, because that's what it is. You're not buying a lottery ticket. You're buying a piece of a company with employees, products, and real revenues. Before you buy anything, ask yourself, would I be happy owning this for 10 years, even if the price didn't move tomorrow? If the answer is no, skip it. Rule 3. Margin of safety. Takeaway. Number 3. Your ultimate financial cushion. Honestly, This is one of the smartest concepts Graham ever taught. It's called the margin of safety, and it's the definition of low risk, solid upside. Here's the big idea. You must never pay full price for anything, especially stocks. No matter how smart you are, things can always go wrong. The economy flips, the company messes up, the market panics. You need a cushion. Think of it like engineering. If trucks crossing your bridge weigh £10,000, do you build the bridge to handle exactly £10,000? No, you build it for £30,000. That extra strength is your safety margin. In stocks, if you calculate a company is truly worth $50 per share, you don't buy it at $50. You wait until Mr. Market throws his tantrum and it drops to, say, $30 or less. That $20 gap is your margin of safety. This gap protects you from costly mistakes and ensures that even if you misjudge the business slightly, you still have room for error. A great business purchased at the wrong price is still a bad deal. Have you ever felt that FOMO when a stock you love just keeps running higher and higher? The temptation is to jump in. Don't chase. Stay patient. Wait for Mr. Market to throw one of his classic mood swings, and trust me, he will. Warren Buffett said, "The stock market is designed to transfer money from the impatient to the patient. Your edge isn't just knowing what to buy, it's knowing when to buy." Rule 4. Defensive versus enterprising. Takeaway number 4. Pick a side. Graham insists you must pick a side. You are either a defensive investor or an enterprising investor. Floating in the middle leads to confusion, chasing trends, and losing money. Defensive investor. This is the path for most people. You don't time the market or chase breaking news. Your strategy is simple. Buy broad, boring, beautiful index funds, like the S&P 500. You invest consistently every month. That's dollar-cost averaging. You check your portfolio once a year, rebalance if needed, and let compounding do its magic. This is how most people win long-term. Enterprising investor. This is for the financially obsessed. You have the skill, the time, and the discipline to read financial statements for fun, analyzing businesses, hunting for those deeply undervalued stocks. This is serious work. Graham was super clear. If you don't have the time or the skill to research properly, be defensive. If you float in the middle, you get wrecked, buying high, selling low, and panicking when things drop. Don't dabble. Rule 5. Emotional discipline. Takeaway number 5. The glue that holds it all together. Your brain is your biggest enemy when it comes to investing. Graham said the difference between successful investors and broke ones isn't intelligence, it's emotional discipline. We've all seen it. The market drops 5%, and suddenly everyone is acting like it's 2008 again. Or a random stock explodes and greed kicks in. FOMO takes over. Look at history. Markets crash, markets rebound, markets crash again. Some people panic sold everything in 2020. Others stayed chill, kept buying great businesses, and ignored the noise. Guess who came out richer? Your job isn't to control the market. Your job is to control yourself. How do you achieve that discipline? You have a system. When you have rules, like dollar-cost averaging and sticking to your plan, you don't need to make decisions based on panic or hype. It's like flying a plane through turbulence. The pilot follows the system. They don't start yanking the wheel. Control your habits, and you control your future. Bonus: Buffett's cash warning. Now, let's talk about the specific warning from Warren Buffett that proves Graham's rules are still active today. The cash is king lie. Warren Buffett frequently warns against holding excessive amounts of cash. He says, "Cash is always a bad investment." Why? Because cash is guaranteed to depreciate in value over time due to inflation. You need cash for oxygen to survive, but you don't need excessive surplus cash. Buffett prefers owning productive assets, assets that deliver value over time. Consider his famous analogy, gold versus a farm. If you owned all the gold in the world, you'd have a massive cube. You could climb on it, polish it, stare at it, but it isn't going to do anything. Your only hope for profit is that someone else, later, will pay you more. But if you buy a farm, you value it based on what it will produce: corn, soybeans, cotton. The success of that investment is determined by what the asset delivers, not by hoping the price goes up tomorrow. This is the mindset of an intelligent investor. When Buffett buys a business, he doesn't care if the stock exchange closes for a few years. He looks at the business and what it can deliver. He looks at the value first, then the price. To make sure the business is strong, Buffett has practical rules of thumb. Strong companies rarely use debt. They have more cash than debt and a low debt-to-equity ratio, ideally below 0.8. He wants to see retained earnings consistently growing, showing the business is profitable and reinvesting profits, even during economic stress. These practical financial habits protect the company, and they protect you. The final puzzle. Here's the key takeaway. Investing is more about discipline, patience, and avoiding huge losses than it is about making huge gains. These 5 principles, treating stocks like real businesses, demanding a margin of safety, ignoring Mr. Market's mood swings, picking your investment style, and mastering your emotions. They work together. Without discipline, none of this matters. The Intelligent Investor is not a book that promises excitement. It promises results. Results for those willing to think logically and act with patience. Now, we barely scratch the surface of Graham's or Buffett's wisdom. If you want me to do a part 2 where we dive into Buffett's 6 rules for analyzing your own potential, investing in yourself, let me know in the comments below. Like this video if it helped you gain an edge, and subscribe for more deep dives into timeless wealth principles. I'll see you in the next video.